Hi, I'm Ross from Smith Property Accountants in Hamilton. I'm going to talk today about using two banks to buy a rental property and how that can work for you. We get so many questions about this. I think it's a lot easier for mortgage brokers or bankers just to say use one bank. It's simple, it's easy, but that's not always the best way for you. So with two banks, often that can separate your risk a little bit. You can have your personal house with one bank and your rental property with another bank, and that can help you protect your family home and also build your assets quicker long term as well, because you can build with both banks. So just to start with, a quick disclaimer. This is just general information for your general knowledge. It's not specific advice for you. So if you're looking at doing this, talk to your mortgage broker, talk to your banker, talk to your accountant, and get some further advice. So if at the moment you've got your personal house and it might be with ANZ, for example, all the banks, I don't have any preference. They're just used for example. So your personal house is worth 600,000. You're looking at buying a rental property with 400,000. So what we might do is we might go to BNZ and look at buying the rental for 400,000. They'll generally lend 70% or 280,000. And just for an example, that would be a loan to, you might use an LTC to buy it. So it'd be a loan to the LTC secured over the rental property. But where's the rest of the money? Where's the other 120,000 that we're missing? So your personal house in general, ANZ Bank is going to lend 80%. 80% of 600,000 is 480,000. Their current debt might be 220,000, so there might be 260,000 of available equity. So what we do is we take some of that available equity. We borrow an extra 120,000 with ANZ. Again, a loan, following the example before, a loan to the LTC, but it would be secured over the personal house. So the 120,000 goes in, helps you to buy the rental property for 400,000. So we get 280 from BNZ, we get 120 across from ANZ, enough to buy the whole property of 400,000 with 100% debt. And there'd still be 140,000 equity left. So you could go off to a third bank, you could go off to Westpac and buy another rental property if you had enough income to do it, and use that 140,000 as a deposit on the on the second rental property. So in summary, you would have a personal debt of 220,000 with ANZ. LTC would have two debts. It would have 280,000 from BNZ secured over the rental property. It would also have a second loan of 120,000 from ANZ secured over the personal house. Just a couple of little tips for tax. So obviously we want 100% of the debt to be on the rental property. That way all the interest on the loan is tax deductible. A big thing, security doesn't matter at all. It doesn't matter what the loan is secured over. It doesn't matter if it's secured over your personal house, your parents' property, your parents' term deposit. It's all, what is that loan actually used for? So if the loan is used and loaned to the LTC to buy a rental property, then the interest will be deductible. So hopefully you've enjoyed my little information. Hopefully you found that useful. Also watch out for my other video that's very similar to this one, but it's about if your personal house is going to become a rental and then buying a new personal house, how that works for two banks as well. Thank you very much.